All right, let's break down the latest from designer brands. They just dropped a Q2 earnings report that's a real head-scratcher. A huge beat on profit, but sales are actually falling. We're going to unpack what that means, dig into management's game plan, and figure out what it could all signal for the stock.
Here's how we're going to do it. First, we'll hit those conflicting headline numbers. Then, we'll go inside the earnings call to hear what management has to say for themselves. After that, we'll zoom out, put it all in context, and then I'll give you our prediction for Q3 and even look at one way traders might be thinking about this thing.
Okay, first up, let's talk numbers. Because the story of this quarter is really about two very different results that happened at the exact same time. It's the core conflict we need to get our heads around. So on one hand, you've got this number, adjusted earnings of 34 cents per share. Now that is a really solid number that told the market right away that these guys have a tight grip on their operations. And to put that into perspective, Wall Street analysts, were only expecting something around 22 cents. So this wasn't just a little beat. This was a massive upside surprise on the bottom line. Really impressive. But, and this is a big but, here's the other side of the story. Revenue. It came in at just under $740 million, which was actually down 4.2% from the same quarter last year. So what gives? How can you absolutely crush it on earnings but have your sales going in the wrong direction? You've got this awesome cost control hitting a pretty soft consumer. That right there is the real mystery of the quarter. Let's figure it out. So how does management explain this split personality report? Well, for that, we have to go inside the earnings call, where they laid out what I would call a very deliberate, very defensive playbook. And this quote from the CEO, Doug Howe, it says it all. He basically explained that the sales dip wasn't an accident. It was a conscious choice. They decided to stop chasing what he called empty-calorie digital sales. In other words, they're picking profits over pure, maybe less profitable growth.
So, the whole game plan here is defense, defense, defense. They're focused on what they can actually control. They're cutting costs, they're fixing their inventory, fewer styles, but more of the sizes people actually want, and they're pushing people to their physical stores, where, by the way, conversion was actually up 1%.
But, and this might be the most telling part of the whole call, despite all that progress, they refused to make any promises for the rest of the year. By holding back on guidance, they're flashing a giant warning sign that they are very, very cautious about what's coming next for the economy. Okay, let's zoom out for a second and put this quarter into the bigger picture. This will help us understand why Wall Street is calling designer brands a show-me story. Basically, the company has to prove it can deliver, not just talk a good game.
And wow, this chart, it paints a pretty stark picture, doesn't it? Over the last year, while the rest of retail and consumer stocks been rallying, DBI stock is down over 20%. It just highlights the huge long-term challenge they have in winning back investor trust.
However, check this out. Just look at the last month. The stock is up a massive 64%. So what that tells you is that investors are absolutely rewarding these recent signs of discipline, even if they're still a little skeptical about the long-term growth story. So you've got this company showing great discipline, but it's facing this long-term skepticism. What does that mean for the next report? Well, here's the official Talk Ticker's view for Q3.
Okay, here's our call. We believe their laser focus on cutting costs is going to continue. That should let them squeak by Wall Street estimates with earnings around 25 cents. But because they're still pulling back from those empty-calorie sales, we do expect revenue to drop slightly again. Until we see a real path to top-line growth, we're calling it a market perform with a price target of $4.75.
This whole situation, the internal progress mixed with all this external uncertainty, it creates a really fascinating puzzle heading into the next earnings report. So, just for fun, let's explore one way you could think about it.
I mean, this is the key question, right? You've got real, tangible progress on profits, but a complete black box when it comes to the future. And that kind of uncertainty, well, that's what creates volatility.
So one potential strategy to play that volatility is something called an option straddle. Now, this is a trade that isn't a bet on which way the stock will go, but a bet that it will make a big move, either up or down, after the announcement. The thinking behind a straddle here is actually pretty simple. The next earnings call is almost a 50-50 binary event. If management finally brings back guidance, that clarity could send the stock soaring. But if they punt on guidance again, all that uncertainty could send it tumbling. A straddle is designed to cash in on exactly that kind of big swing, no matter the direction. And of course, you know we have to say it. This analysis is purely for informational and educational purposes. It is not financial advice. Please always do your own research.